Hello everyone, welcome to Week 8 learning videos. We have 4 learning objectives today and we mostly discuss about small cap and growth investing, and as usual I will be uploading separate videos on each of these learning objectives. In this lecture, as I mentioned, we look at growth investing. In the previous class, we looked at the benefit of value investing. And when talking about the value investing, we have discussed value and growth investing as being opposite end of the spectrum. So it's important to note that if there is a strong evidence that on average value portfolio outperforms growth portfolios, then why there is still there might be some merit in growth investing. Or why is that there are so many growth funds that exist across the Australian market and indeed across international markets. So first of all, it's important to note that growth investing is actually buying companies where investors believe that the value of the growth potential of the firm is being underestimated by other investors. So as a growth investor, you believe that your competitive advantage lies in being able to identify and estimate the value of growth relative to other people in the market. So if you are better able to price growth options within a firm, you might be able to get a better measure of the fundamental value of growth firms. Hence, identify those particular ones that are either over or underpriced. Now, despite the evidence reported in the previous lectures that passive value funds do outperform passive growth funds, there may still be some merit in growth investing. So let's look at the possible justification for investing in growth. First of all, Damodaran in 1994 shows that while passive value investors outperform passive growth investors, there may be some merit in growth investing if you are an active investor. The best evidence of that comes from the fact that on average, active growth investors actually tend to outperform passive growth indexes, whereas an average active value investors underperform passive value indexes. So what does this mean? It means that while an average growth stocks underperform, there may be a greater ability to identify underpriced stocks within the growth space compared with the ability to identify underpriced stocks within the value space. And as an active investor, there might be a justification for investing in growth. Another potential justification for investing in growth is the idea that while on average value outperforms growth, value does not outperform growth in every single period. There may be some periods when growth outperforms value. In fact, the periods where growth outperforms tend to be the periods which are predictable. For example, growth tends to outperform when the yield curve is downward sloping. So what we have on the screen is the blue line that shows the relative interest rates of treasury bonds versus treasury bills, or the difference between the long-term and short-term interest rates throughout the time. The red line, on the other hand, is the average return of growth portfolios less value portfolios. So if you look at this red line, on an average, the red line is negative. So if we took the average across the whole time period, and we see that the average of this red line is negative. However, we can see that there are some spikes of these red lines which indicate that the growth outperform value. And if you particularly look at these red spikes corresponds to the period when this blue line is particularly negative, implying that the yield curve is downward sloping. So again, getting back to the idea that there might be merit in growth investing for active investors if you're a market timer. So if you're a market timer, then there may be some benefit in shifting into growth stocks in periods where you have got downward sloping yield curves, which is implying periods when you think maybe the economy is about to contract in the near future. This is because when you have significant drawdowns in the economy, those drawdowns tend to affect the value stocks because they are cheaper, more neglected, and potentially low quality names. This type of stocks are often more highly affected by financial crisis. So this is the second reason why there might be some merit in growth investing. It's part of market timing. The third reason to invest in growth relates to alternative utility preferences of investors. Chang in 2011, looking at growth versus value, reports that there is actually differences in skewness characteristics of these two different types of stocks. On average, growth stocks tend to generate positive skewness. You can see here. Whereas adjusted skewness or the market adjusted skewness of value stocks tend to be negative. Therefore, comparing value and growth, the zero investment value portfolio that is going long in the value stocks and going short on growth stocks tend to be negatively skewed. So if you are an investor with skewness preferences, if you are getting utility out of positive skewness, you might be willing to accept the slightly lower average return generated by a growth stock because you are getting positive skewness, whereas you might be averse to negative adjusted skewness of value stocks. While people have now built up an argument that there may be some merit in growth investing, now we are going to look at different types of growth investors. That is, in different ways that investors can adopt this particular approach or this particular philosophy. There are three different approaches to implement growth investing. The first one is a small cap investment. The simplest form of growth investing is basically buying small companies' stocks. These small companies are expected to be high growth companies, and you would expect that the market might underestimate the value of growth within these firms. So there may be some belief that small firms outperform big firms. Another way of looking at growth is thinking about IPOs. An initial public offering is where a firm first accesses public equity or first lists on a stock market. The idea here is that if a firm is listing on the stock market, they are sourcing a whole lot of additional capital, and generally this is an indicator of a firm with strong growth prospects, and potentially investing in IPO may be a way to generate abnormal profits. Last of all, we are going to look at passive growth screens, and what's important to note here is that passive growth screens are not simply just the inverse of screens used by value screeners. A growth screen tends to use measures of growth at a reasonable price. So growth screens try to identify firms with strong growth prospects, yet whereby you don't pay too much for that growth in terms of the market price of the firm.